today. My name is Wesley Boudreau, one of the financial advisors here at the Retirement Group. I'm going to give you a quick update on the interest rates and how they're used to calculate the Chevron pension lump sum. And I know a lot of you are on pins and needles with this because we're seeing some drastic changes with inflationary pressure over the last few months and probably going to see some more going forward. Before I get started, I just want to remind everybody the Retirement Group, we are an independent financial advisory firm. We're not affiliated with, nor are we employed by Chevron. However, we've been working extensively with Chevron employees and retirees for many years, so we have a deep understanding of not just the pension plan, but the 401k and healthcare options. So any questions you have, feel free to give us a call, and we'll be happy to go over that with you. To go ahead and remind everybody the pension plan, again, it's a classic defined benefit plan, in which case there's a calculation that looks at your years of service and your final average pay and a multiplier to determine what your single life annuity is going to be. From that point, if you don't want the single life annuity, you'd rather take that lump sum, what's going to happen is Chevron's going to look at your age and the life expectancy to determine how many more years or months they have to pay you. Then look at interest rates to do a net present value calculation to find out how much they have to give you as a lump sum for you to essentially go out and recreate that annuity. So what we see is as interest rates are low, there's a higher lump sum. When interest rates are high, there's a lower lump sum because, again, if there's low interest rates, they have to give you more money for you to go out there and try and recreate that annuity payment yourself. So look at that chart up there at the top. Just keep in mind that seesaw pattern. As interest rates go up, you'll see your lump sum fall. As interest rates go down, you'll see it rise. And we saw that dramatically during the pandemic. Interest rates went down to historic lows, which meant we saw lump sums hitting historic highs. Now we're on the flip side of that. We're seeing some massive inflationary pressure, and we're seeing the interest rates not just move up, but move up quickly. So we're seeing those lump sums decline. For many of you that are looking to retire in the next year or two, or especially the next couple months, it's very important to give us a call to run these numbers to see where you stand, because it's not unheard of to see people hang on too long and actually work for free if they're looking at taking a lump sum. An example could be if you're thinking about taking the lump sum and you hang on for, let's say, another quarter or so and you lose $30,000, but maybe you make $10,000 a month, you're essentially working for free. So it's really important to understand that. Now, in order to give you kind of a calculation method of how the pension lump sum works is, again, they use interest rates, as I mentioned, to calculate it. What they use are the segment rates, the Pension Protection Act segment rates, which are released on a monthly basis. And they're not usually released until about the third or fourth week of the following month. So that's why we just got them for January. Chevron looks at a rolling monthly average. And what they do is they look at the average of the third, fourth, and fifth prior month to determine what your average is going to be for the month of commencement. So again, you need to retire first, then you have your commencement date. The reason I say that is because in the past year or so, when interest rates were on the decline, you could actually retire and defer commencing your benefit, so that way you could actually get a lower interest rate and a higher lump sum. The other factor to be aware of is going to be your age penalties. If you're deciding to elect your benefits prior to age 60, there are age penalties to discuss as well. So that's why it's important to give us a call to go over this one-on-one as well. But we take a look at those segments. They're broken up into three segments. There's going to be the first segment, which correlates to the first 5 years of retirement. Second segment correlates to years 6 through 20. And the third segment is going to be for years 21 and beyond. So for most of us, the bulk of our retirement is going to be in that 15-year window, that second segment. So that has the highest weighting when we go to look at the calculation method. Now, let me kind of zoom in here so we can kind of see a better look at these interest rates. We look at the top line, February, the rates we just got. If we look at that second segment, it was 3.35%. January, the month before, it was 3.02%, so 33 basis points lower. In December, it was 2.72%, so 30 basis points lower than that. So we've seen a drastic 63 basis point climb in just the last 2 months or so. And we're going to continue to see that probably. We don't have March rates out. We won't get them out until April. But if we look at the 10-year Treasury, which is a good indicator, it started out in March at 1.72% and has already climbed to 2.38% as of today. So we're already seeing over a 60 basis point jump there. We'll see how it actually correlates as the month winds down and what the Fed puts out for the Pension Protection Act segment rates for March. Now, if we take a closer look, let me back up. If we look at some of the historical averages I put in there just for reference, in red we've got the historical low, that 2.26% back in December of 2020. So we'll see it's not too far off of that, but again, it is off the lows. And we look at the high, not the high, but just a recent rate of March 2019. We're actually at 4.39%, so it's there to give you an idea of where we could go. I'm not saying we're going there, but with the inflationary pressure we're seeing and what I just mentioned about the rates going forward, it's likely we could climb that high. It's just a matter of how quickly and when do we get there. Now, if we look at the interest rates, again, they're done on a monthly basis. So if we look at the averages for May 2022, that middle segment is going to be 3.03%. If we look at April, it's 2.82%. So that's a 21 basis point difference. So let me kind of put that in numbers for you. Let's say if you had a pension lump sum calculation that you looked at and you ran it for April, and it was going to be $500,000. Everything else held equal, if you ran it for May, you're going to lose probably about $10,000 in that lump sum. If it was $1 million, you're going to lose about 20 grand or so. If you look at March versus May, you're going to see an even greater drop in there as well. So chances are, when we get the new rates out and we see that change for June, it'll be even greater drop. So you could be looking at, on that $500,000 example, losing $10,000 to $15,000 per month as inflation continues. So that's why it's really important to give us a call and look at reviewing this situation if you're on the cusp of retirement. And even if you're thinking about retiring in a couple years, it may still be something that's worth looking at, just so you know what those options are, especially if you were looking at deciding contract work or other options as well, if you wanted to take advantage of your pension lump sum. Now, again, keep in mind this is only going to be on the lump sum calculation. It does not have an effect on your annuity. So if you have any question on there, just give us a call. We can go over that as well. And you can reach that 1-800-900-5867 or info@theretirementgroup.com. If you'd like to schedule an appointment with myself or one of the many advisors we have here that understand the Chevron plans, you can also hold your phone up and follow that QR code to set up an appointment. Or if you also want to make sure that you're updated on our LinkedIn page, so you get these monthly updates on the interest rates or any other updated changes we have with the Chevron plans coming forward, we'll be happy to update that with you as well. So again, I want to remind everybody, 1-800-900-5867. And I want to, again, remind you that the retirement group we're not affiliated with, nor employed by Chevron. But should you have any questions, we're here to help you out with that. I want to thank you, and I hope you have a great day.